You are scrolling through YouTube at 1 a.m., half asleep. Your feed is absolutely drowning in finance content. Some guy with a deep AI voice is telling you the secret to building wealth. Next video, another guy, different avatar, same voice, explaining compound interest, like he invented the concept. You scroll again. Another one, male voice, male character, male perspective. It is like the entire financial education corner of the internet collectively decided that women don't need to understand money, or worse, that women don't want to understand money. And you sit there thinking, where is the voice that actually sounds like me? That is the gap that has been eating at me for months. Because here is what I know after spending 17 years in investment banking. I watched how the wealthiest people on the planet actually move their money, not what they post on Instagram, not what they tell journalists, what they actually do behind closed doors with their capital. And I can tell you with absolute certainty, the financial advice industrial complex is failing you in ways that are costing real families real money. We're talking hundreds of thousands of dollars over a lifetime, just evaporating. Because nobody bothered to explain the basics without a finance degree to decode. Think about that for a second. You spent 12 years in school, maybe 16, maybe 20, if you went for a master's. You can probably name every planet in the solar system. You might even remember that the mitochondria is the powerhouse of the cell, a fact that has generated exactly $0 of income for anyone who learned it. But nobody at any point in that entire educational journey explained how interest rates work. Nobody told you what happens to your credit score when you close an account. Nobody walked you through why your coworker, who makes half your salary, has 3 times your net worth. Instead, we hand 18-year-olds a pen and say sign here for $80,000 in student loans. We don't explain amortization. We don't explain what default means. We don't explain that the interest on that loan compounds while they're figuring out their laundry. It is like tossing someone the keys to a Formula One car when they've never ridden a bicycle, and then blaming them when they crash into a wall at 200 miles an hour. And then, after they graduate, financially clueless, the internet swoops in with its brilliant advice: skip your $4 morning coffee, cancel your streaming subscriptions, stop buying avocado toast. As if the reason you can't build wealth is because you enjoyed a latte on a Tuesday. That advice isn't just useless, it is insulting. It completely ignores the actual architecture of why people stay broke. The real problem isn't your coffee habit. The real problem is that you've been systematically programmed since childhood, programmed to believe that buying things equals progress and convenience equals success. You've been trained to consume, not to build. I've seen people pulling in $200,000 a year who are completely, devastatingly broke. Every dollar gone before the next paycheck hits. And I've watched people earning $40,000 quietly stack wealth month after month through decisions so boring they'd never make it into a viral TikTok. Because wealth isn't flashy. Wealth is a consistency game. It is showing up to the gym at 6 a.m. when nobody is watching, doing your reps, while everyone else is still searching for the magic pill. But here is the thing that really set me off. Every single character-driven finance channel I found online was a male voice. Everyone. As if the algorithm itself decided that financial literacy belongs to men. And I thought, that is it. I'm done waiting for someone else to fill this space. Because women deserve a seat at this table too, not a folding chair in the back, a seat at the table, where the real conversations about capital allocation and wealth building actually happen. So that is exactly what this is. And what I'm about to share might fundamentally change how you think about every dollar. Let me tell you about the 5 biggest financial lies you've been swallowing your entire life without even realizing. They were poison. Lie number 1. You need to make more money to build wealth. This is the granddaddy of all financial delusions, and it keeps the most people stuck. I spent 17 years watching this play out in real time from inside the banking system. Households pulling in $200,000, $300,000 a year with a net worth of practically zero. Exposed. Leverage to the eyeballs. One bad quarter away from complete financial meltdown. Meanwhile, a teacher making $48,000 quietly maxes out her index fund for 20 years. And she is sitting on $600,000, sleeping like a baby. Income is not wealth. Income is the raw material. What you do with it is everything. But nobody tells you that because the entire consumer economy depends on you believing otherwise, that the next raise will finally fix things. It won't. It never does. Because your spending always rises to meet your income unless you deliberately intervene. Lie number 2. Your home is your greatest investment. This one makes me genuinely angry. The real estate industry has been running this propaganda for decades. Your primary residence is not an investment. It is a consumption item with a mortgage attached. When you factor in property taxes, maintenance, insurance, interest, and opportunity cost, your house is often one of the worst returning assets you own. A study from Nobel laureate Robert Shiller showed real home prices barely outpaced inflation over a century. Barely, but we've been conditioned to treat a house like a retirement plan. It is like calling your car a savings account because it has a glove compartment. Lie number 3. Saving money is the path to financial freedom. Sure, saving is step 1. But if step 1 is all you ever do, you're running a treadmill and calling it a marathon. Every dollar in a savings account earning 0.5% while inflation runs at 3 to 4% is a dollar that is actively losing purchasing power. You are not saving, you are slowly bleeding. The banks love this arrangement. They take your deposits and lend them out at 7 to 8% and hand you back pennies. You need to graduate from being a saver to being a capital owner. Savings accounts are a parking lot, not a destination. Lie number 4. Good debt versus bad debt. The financial industry invented this distinction to make you comfortable borrowing money you don't have. They'll tell you student loans are good debt. A mortgage is good debt. A car loan is good debt. But here is what they conveniently leave out. All debt is a claim on your future labor. Every single loan you sign is you selling hours of your future life to a lender at a discount. Some debt can be strategic, absolutely. But the moment you label debt as good, you stop feeling its weight. And that is exactly what they want. They want you numb to the number, comfortable carrying $380,000 in obligations because a television advisor called it smart borrowing. And lie number 5. The most dangerous one of all. Financial literacy is too complicated for regular people. This is the lie that protects all the other lies. Because if you believe money management requires some special credential or genius level IQ, you will never question the system. You'll hand your paycheck to whoever sounds most confident and hope for the best. But here is the truth that 17 years in banking taught me. The math behind building wealth is not complicated. It is addition, subtraction, multiplication, and patience. The financial industry wraps simple concepts in complex language on purpose because confusion is profitable. When you don't understand the product, you can't negotiate the terms. When you can't negotiate the terms, they win. Every single one of these lies has one thing in common. They keep you dependent, consuming, and borrowing. They keep you running on the financial hamster wheel while the people who designed it collect the fee. Now, let me give you the actual math that nobody taught you in school. The stuff that separates people who build wealth from people who just watch it evaporate. The first mechanism is what I call the allocation illusion. The average American household earning $75,000 a year spends approximately 37% on housing, 17% on transportation, 12% on food. That is 66% of gross income gone. Before you even think about taxes, insurance, or that gym membership you haven't used since January. After federal and state taxes eat another 22 to 28%, you are left with maybe 6 to 12%. 6%. That is not a wealth building engine. That is a financial ventilator keeping you barely alive. But here is where it gets genuinely scary. The people earning $200,000 weren't doing better. They were doing the exact same thing at a higher altitude. Bigger house, nicer car, fancier restaurants, same zero savings rate. This is lifestyle inflation, and it is the silent wealth killer that nobody warns you about. Because every single industry on the planet profits from you spending more as you earn more. The second mechanism is the savings account lie. Right now, the average savings account in America pays about 0.5% interest. Some high-yield accounts give you maybe 4.5 to 5%. Sounds decent. Until you realize inflation has averaged roughly 3.5% historically and spiked way above that recently. So your money in a savings account isn't growing. It is shrinking every single year. $100,000 in a standard savings account loses approximately $3,000 in purchasing power annually. Over 20 years, that 100 grand can buy you what $50,000 buys today. You didn't spend a dime, and you still lost half your money. That is what I mean by financial suicide in slow motion. The bank isn't protecting your wealth. It is borrowing your wealth at almost zero cost and lending it out at 7, 8, 24% on credit cards. You are funding their profit machine. The third mechanism is the compound gap, and this is the one that costs families hundreds of thousands. Person A starts investing $300 a month at age 25 into a basic S&P 500 index fund. Person B waits until 35 and invests $500 a month into the exact same fund. By age 60, Person A has approximately $1,130,000. Person B, despite investing $200 more every single month, has around $680,000. Person A invested a total of $126,000. Person B invested $150,000. More money in, less money out. The 10-year head start created a $450,000 gap. That is not magic. That is compound interest. Rewarding time over amount. And every year you wait costs you exponentially more than the year before. Now you might be thinking, okay, Penny, I get it, but I don't have $300 a month. And I hear you, but let me flip that around. The average car payment in America right now is $726 a month. The average American spends $166 a month on subscriptions they forgot they even signed up for. That is nearly $900 a month bleeding out toward things, losing value, or delivering zero utility. You don't have an income problem. You have a capital direction problem. The money exists. It is just flowing to the wrong places. Here is the fundamental thing you need to understand. Wealth is not built by earning more. Wealth is built by capturing a percentage of what you earn and redirecting it into assets that compound while you sleep, instead of depreciating when you swipe. The wealthiest clients I worked with in banking didn't have secret investments or offshore accounts. They had boring automated systems. A fixed percentage of every paycheck moved into investments. First, they treated investing like a bill due on the first of every month, non-negotiable, like rent. And they did this for decades, not because it was exciting, because the math literally cannot fail. The S&P 500 has never lost money over any 20-year rolling period in its entire history. Never, not through wars, recessions, pandemics, or financial crises. So here is the part where I need you to get uncomfortable. Because everything I've described so far, the system, the traps, the programming, none of that is actually your biggest problem. Your biggest problem is the person you've been pretending to be. And I say that with love, but also with 17 years of watching people destroy their financial futures while smiling for Instagram. You've been walking around with an identity handed to you by corporations, algorithms, and culture. A culture that measures human worth in monthly payments. You didn't choose this identity. You absorbed it. You absorbed it every time a commercial told you upgrading your phone would make you feel complete. Every time a car dealership told you that you deserved this. Every time a real estate agent whispered you should buy at the top of your approval range. Because you have earned it. And here is what makes me genuinely angry about this. You internalized a financial identity before you ever had a chance to build a real one. You started calling yourself a homeowner before you understood amortization schedules. You started calling yourself an investor because you bought $50 of crypto on a Tuesday night after watching a TikTok. You started calling yourself financially responsible because you pay your minimum payments on time. That is not financial responsibility, that is financial obedience. There is a massive difference. The old you, the version that has been operating on autopilot until this exact moment. That person believes wealth is something that happens to lucky people. That person believes budgeting is restriction. Investing is gambling with extra steps. That person checks their bank account with one eye closed because the number might hurt. I know, because I sat across from that person thousands of times in my career, earning $200,000 a year, and terrified to look at their own net worth statement. That version of you has to die today, not tomorrow, not after the next paycheck, not after the holidays. Today. Because here is the math that should keep you up tonight. Every single month, you operate under your old financial identity costs you not just the money you waste, but the compound growth on the money you waste. A 30-year-old who redirects just $400 a month into a basic index fund, averaging 8% annually, will have over $710,000 by age 60. That is not a fantasy, that is arithmetic. And every month you delay, clinging to the identity of someone who needs the latest and newest. You are not just losing $400, you are losing what that $400 could have become. You're burning future wealth to maintain a present illusion. Now you might be thinking, Penny, I already know I should be saving more, I should be investing. And that is exactly the trap. Knowing is not an identity, doing is an identity. The person who knows they should go to the gym, but never goes, is not an athlete. The person who knows they should invest, but never sets up the automatic transfer, is not building wealth. They are building a fantasy. So here is what I need from you right now, not next week, right now. Make one decision that your old identity would never make. Open that brokerage account you've been thinking about for 6 months. Set up a $100 automatic monthly transfer into an index fund. Cancel one subscription you forgot you were even paying for. Sit down for 20 minutes and actually calculate your net worth, assets minus liabilities. Even if the number makes you sick. Pick one. Do it before you close this video. Because action is the only thing that separates the person you are from the person you're about to become. Your old financial self was a product manufactured by systems that profit from your confusion, your insecurity, and your inaction. Your new financial self is a decision. And that decision starts with something brutally simple. Stop performing wealth and start building it. Stop optimizing your appearance and start optimizing your cash flow. Stop asking, what can I afford? And start asking, what is this actually costing my future? The system does not want you to make this shift. The system needs you asleep at the wheel, swiping, subscribing, upgrading, and calling it progress. Wake up. Your future self is watching what you do next.